Hey traders, welcome back to our Candlestick Secrets series. Today we're taking a thrilling plunge into the world of bullish reversal patterns. These are powerful candlestick formations that hold the key to spotting market reversals. They act as beacons, guiding us when the market is about to change course from a downtrend to an uptrend. Why is this important, you ask? Well, recognizing these patterns can provide lucrative trading opportunities, allowing you to ride the wave right from the onset of a bull market. In this video, we're going to uncover the secrets of 13 such patterns. We'll talk about the hammer and the piercing pattern, explore the bullish engulfing and the morning star, march with the three white soldiers, shine a light on the white marubozu, and many more. So buckle up and get ready to master the art of spotting bullish reversal patterns. Let us start with the first two patterns, the hammer and the piercing pattern. First up, the hammer. A small yet mighty player in the world of candlestick patterns. Imagine being in a fierce battle of the markets where the bulls and bears are locked in a tug of war. Suddenly a hammer appears, standing tall with its small body at the top, a long lower wick and a minuscule upper wick. This formation is a beacon of hope in a downtrend, as it signifies the bulls are starting to flex their muscles and gain strength. Remember, the longer the lower wick, the stronger the potential reversal. So when you spot a hammer, it's time to get ready for a potential upward swing. Next, let's illuminate the piercing pattern. Picture a market shrouded in darkness, the bears in control. But then a ray of hope pierces through. This is symbolized by a piercing pattern, a two-candle formation that starts with a bearish candle. The following day, a bullish candle opens below but closes above the midpoint of the previous day's body. This sudden shift from darkness to light suggests that the bulls are starting to take control, pushing the market upward. It's like a sunrise after a long night, signaling the dawn of a new day and a potential bullish trend. Understanding and identifying these patterns can provide valuable insights into market sentiment. They serve as a lens to view the emotional dynamics of the market, revealing potential reversals before they happen. With the hammer showing the bulls growing strength after a downtrend, and the piercing pattern indicating a shift in control from bears to bulls, you're equipped with powerful tools to navigate the financial seas. With these two patterns, you're already on your way to becoming a more insightful trader. Next up, we have the bullish engulfing and the morning star. Let's start with the bullish engulfing, a gladiator in the arena of reversals. This pattern unfolds like a dramatic play on your trading charts. Act 1, a small bearish candle takes the stage, representing a day when sellers had the upper hand. But then in Act 2, a larger bullish candle bursts onto the scene, completely engulfing the previous day's candle. This is the moment when the market sentiment shifts and the bulls take over. The bullish engulfing pattern is a clear signal that the bears are losing their grip on the market, and a bullish trend could be on the horizon. Now let's welcome the morning star to the stage. This pattern is like a tale of redemption in 3 acts. Act 1, a bearish candle descends, reflecting a day dominated by sellers. Then in Act 2, a small-bodied candle appears, indicating a pause or indecision in the market. Finally, in Act 3, a bullish candle rises, overpowering the bearish sentiment and introducing a potential upward trend. The morning star is a beacon of hope for traders in a downtrend, signaling the dawn of a new bullish era. These two patterns, the bullish engulfing and the morning star, are powerful tools in your trading arsenal. They can help you interpret market sentiment and anticipate potential trend reversals. But remember, candlestick patterns are not standalone indicators. Always consider them within the broader market context and corroborate with other technical analysis tools. Understanding these patterns can help you spot potential trend reversals early. Let's move on to the three white soldiers and white marubozu. Picture a battlefield where 3 soldiers march forward, their white uniforms shining brightly. This is the image that the 3 white soldiers pattern paints. When you see 3 consecutive bullish candles, each opening within the body of the previous candle and closing higher, you have spotted the 3 white soldiers. This pattern suggests a strong shift in market sentiment from bearish to bullish. Now let's meet the white marubozu, a candle with no shadows. It's like a confident bull charging forward without any hesitation. The absence of shadows means the day's opening price was the low, and the closing price was the high. This indicates strong buying pressure throughout the day and can be a powerful sign of bullish sentiment. These patterns, the three white soldiers and white marubozu, can be powerful indicators of bullish sentiment. Next, we'll dive into the three inside up and the bullish harami. To comprehend the three inside up, visualize a dance between two candles. The first is a bearish candle that's been leading the dance, but the second, a bullish candle, steps inside the range of the first, initiating a change in rhythm. The third candle, also bullish, closes above the high of the first, completing the pattern. This dance signals that the bears are losing their grip and the bulls are ready to take the lead. The magic of the three inside up pattern lies in its simplicity. It's a clear signal that the market sentiment might be shifting from bearish to bullish. Spotting this pattern can be like finding a compass in the wilderness of the markets, guiding you towards potential profitable trades. Now, let's turn our attention to the bullish harami. This pattern gets its name from the Japanese word for pregnant. A strange name for a candlestick pattern, you might think, but it perfectly describes the formation. The bullish harami consists of a large bearish candle followed by a smaller bullish candle nestled within the body of the first. The bearish candle represents the mother and the bullish one, the baby. This pattern is a sign that the bear's dominance might be waning and the bulls could be preparing to step in. So, how can you use the bullish harami to your advantage? Spotting this pattern at the end of a downtrend can be a clear indication that the direction of the market may be about to change. It's like a flare in the night sky, signaling that it might be time to switch from short to long positions. In the volatile world of trading, spotting these patterns can be a game changer. The three inside up and the bullish harami are like secret codes revealing potential shifts in market sentiment. Both of these patterns can signal a shift from bearish to bullish sentiment. Finally, we have the tweezer bottom, inverted hammer, three outside up, on neck pattern, and the bullish counterattack. Firstly, let's talk about the tweezer bottom. Picture a pair of tweezers, but instead of plucking, they're picking up the price at the bottom of a downtrend. This pattern, consisting of two or more candles with matching lows, forms a support level, suggesting a potential trend reversal as buyers step in to lift the market. Next, let's flip the hammer and meet its cousin, the inverted hammer. This candlestick has a long upper wick, a small body at the lower end, and little to no lower wick. It's like a hammer standing on its head. This pattern hints at a potential bullish reversal after a downtrend, as it shows the bulls are testing the market to drive prices higher. Now imagine a trio of candles where the third one engulfs the first two. This is the three outside up, a bullish reversal pattern. It's a clear sign of a shift from bearish to bullish momentum, indicating that the bears are losing their grip and the bulls are ready to take charge. Moving on, let's look at the on-neck pattern. This pattern features a bearish candle followed by a bullish one that closes near the previous candle's low. It's like the market taking a breather, gathering strength for a potential bullish reversal. This pattern suggests that buyers are slowly gaining control and are ready to push prices higher. Lastly, we have the bullish counterattack. Picture a bearish candle followed by a bullish one that opens at or below the previous day's close, but closes at the same level as the previous day's open. This pattern signals that bulls have counterattacked, potentially shifting the momentum and kicking off an uptrend. Mastering these patterns can help you spot potential bullish reversals and make more informed trading decisions. And there you have it, traders. We've journeyed through the intriguing realm of bullish reversal patterns, decoding 13 powerful candlestick formations. From the resilient hammer to the dynamic piercing pattern, each pattern offers a unique insight into the shifting power dynamics of the market. We've seen the gladiatorial might of the bullish engulfing, the dawn of a new era with the morning star, and the triumphant march of the three white soldiers. We've met the dominant white marubozu, the dynamic three inside up, and the fascinating bullish harami. Our journey also introduced us to the supportive tweezer bottom, the flipped script of the inverted hammer, the engulfing power of the three outside up, the near closure of the on-neck pattern, and lastly, the counter-attacking prowess of the bullish counterattack. Remember, understanding these patterns is just one part of the trading puzzle. Always consider other factors and use proper risk management. Happy trading!